So this video, I bring before you the basics of the international monetary systems, along with concepts like the gold standard, followed by the Bretton-Woods, and then we'll talk about fixed exchange rate, floating exchange rate, and the flexible exchange rate. At the end, we'll talk about the role of IMF, International Monetary Fund, and the IBRD, which is also known as the World Bank. And then we'll talk about the special drawing rights, which are issued by the IMF to its member nations. So this video is part of my assignment for the last semester, and I thought of uploading on YouTube so that it may help future students and those who are confused about these topics. So we'll move to the presentation, which I would use to explain these concepts. Okay, so we'll start with the gold standard, followed by the Bretton-Woods, then managed floating, which is a combination of fixed and flexible exchange rates. Then we'll go to IMF and the World Bank, and at last we'll talk about the special drawing rights. So starting with the gold standard, in the initial, I'll tell you that gold has been used as a measure of currency or something of economic value for the last 5,000 years, either for trading purposes or also for worshipping and other purposes, cultural purposes, especially in Asian countries like India. So in the gold standard, what happens is that the currency or paper money has a value directly linked to the gold. So the more amount of gold a country can store or hold, the more paper money it can issue. So it was unofficially, it has been continuing since many centuries, but in 1821, England officially adopted a gold standard, which was through the Coinage Act by the Bank of England. It received the royal status, it received the royal status, it became the official currency. Then in 1871, it became a worldwide phenomenon. It became in 1871, Germany also accepted the gold standard in 1871, followed by the other countries. And so in this period, 1871 to 1914, we can say the gold standard was at its pinnacle. Every country in the world accepted the gold standard, and near ideal political conditions existed in the world. There was no trade barriers because everyone knew that they can trade with other countries through its gold reserves. And yes, it was the basis of international trade in the decades prior to the First World War. One of the advantages of the gold standard was that the physical quantity of gold, which is a finite amount at a certain amount of time, acts as a deterrent for inflation. You cannot print more money than the amount of gold you have. Moving across to the Bretton-Woods, which was the monetary system after the Second World War. So according to the Bretton-Woods, the US dollar was pegged to gold and other country currencies were pegged to the US dollar. So the primary designer of the Bretton-Woods system was the British economist John Maynard Keynes and American economist Harry Dexter White. Although the Bretton-Woods agreement was held in 1945, but it became only fully functional in 1958. And according to the act, the exchange rate for 35 US dollars, the exchange rate was 35 US dollars for 1 ounce of gold, which in grams, it becomes 28.3 grams. But this system collapsed in 1971 when the US gold supply was no longer adequate to cover the number of dollars in circulation. President Nixon tried to devalue the US dollar, but still this system did not hold. Then you go to managed floating, which is a blend of flexible exchange rate and fixed exchange rate systems. It is also referred to as the regulated floating exchange rate system. So what is the exchange rate? Exchange rate is the rate at which the domestic currency is exchanged for a foreign currency. If we say that like 70 Indian rupees is equal to $1, that is the exchange rate, and it differs from every country. So in the managed floating system, central banks interfere or intervene to purchase and sell foreign currencies by trying to average the exchange rate movements whenever such pursuits are feasible. So the central banks, they try to keep it within a range, certain range. So if it goes above that or beyond that, the central bank either buys foreign currencies or sells its reserves of foreign currencies. Now we come to the fixed versus floating exchange rate. In the beginning, we'll talk about the advantages of both. So in the fixed exchange rate, you have one advantage, that is certainty. The firms know the exchange rate, and so you can make the investment decisions accordingly. There is no tension of the exchange rate fluctuating in the coming months or coming days. Then there is absence of speculation. So there are like people with vested interest in the economy who try to speculate and about the fluctuation of exchange rate, which harms the economy, which harms the investment, the investors. So there is no absence of these people. Then there is constraint on government policy. So since the exchange rate is already given, government cannot pursue irresponsible or extreme macroeconomic policies because they know it will backfire. Coming to the floating exchange rate or the flexible exchange rate, the first advantage is that we have protection from external shocks because the exchange rate will adjust to the whatever is happening in the international market. So even if there is some big problem in the world economy, some big issue happened in the oil markets, for example, or in the European economy, it will not harm the other economies in a very bad way. It will harm, but you will get a warning or in a certain sense protection. There is lack of policy constraints. So the governments are free to pursue policies they feel which will be beneficial for the economy. So in the fixed rate, they cannot do so, but in floating rate, they can take monetary measures. There are two concepts, fiscal and monetary. So the government can pursue monetary measures which can be beneficial for the economy. Then there is the correction of balance of payments deficit. So your balance of payments itself gets corrected due to when your BOP increases, then your home country currency will get devalued and BOP will become stable again. Now coming to disadvantages of both. The first disadvantage of fixed rate is that it is unable to respond to external shocks. Yes, so even if there is something in the world market or in the international stock markets or in the American economy or European economy, the home country cannot respond properly because its rate is already fixed. It cannot revalue or devalue its economy, its currency within a short period of time. Then we come to speculation. There is speculation. You cannot predict whether the economy will be revalued or devalued in the future. If you know the answer, then it would be easy to make an investment decision or to plan something for your business or the economy. But here there is no guarantee whether it would be revalued or devalued. Then we come to deflation. In the case of fixed rate systems, so the countries with high BOP deficits may deflate their economies, deflate their currencies to try to correct their deficits. So it will lead to reduction in the surplus of other countries who have a BOP surplus. So this will set a deflationary trend in the entire global economy. When we come to disadvantages of floating rate, first is instability. It is prone to large fluctuations. If the world market fluctuates, then your home country economy will also fluctuate. You cannot shield your economy properly. Then there is no constraint on domestic policy. The government may try to pursue monetary measures which will end up harming the economy, or they can act irresponsibly. Then there's the problem of speculation. The exchange rate fluctuations due to speculation the exchange rate may fluctuate in a pattern unrelated to the trade system. The trade may be good, but still the exchange rate may go down. That is in the opposite direction of trade patterns. Now we'll come to the IMF, the role of IMF and the World Bank. So the World Bank is also known as International Bank for Reconstruction and Development. So both these entities were formally introduced in December 1945. So what the IMF does is that it monitors the exchange rates and identifies nations that needed global monetary support. At present, the IMF has 189 member countries. So the IMF is more of a regulatory body. It maintains database of different countries' exchange rate, different countries' GDP growth and all. It identifies those countries which need help, especially the underdeveloped countries. So it also helps countries to pursue policies for rapid economic development. The IMF keeps a checklist of policies to adopt and the changes they have to make to jump to a proper economy, rapidly growing economy. Then we come to the World Bank. It was established to manage funds available for providing assistance to countries that were physically and financially devastated by World War II. As we know, many European countries themselves were devastated due to the World War II. So the World Bank gave funds, gave loans, aids and assistance. Loans and assistance are separate things to those countries to help rebuild themselves. Now, since the European countries have bounced back, World Bank gives more loans to the developing and the underdeveloped countries. Now we finally come to the last part, that is the spatial drawing rights. It was created in 1969. It is kind of an international reserve asset to supplement its member countries' official reserves. Initially defined as equivalent to 0.888671 grams of fine gold, which was at the time equivalent to $1. The current valuation is based on a basket of currencies: the US dollar, the euro, the Chinese renminbi, the Japanese yen, and the British pound sterling. So there are two main criterion for any currency to become a part of the SDR. That is the export criterion and the freely usable criterion. So these countries' currency, from the US till British, these are the five main exporters, five top exporters in the world. And also these five currencies are widely used in international transactions, even by foreign countries. So these are the five currencies on which the current valuation is based. And the final thing is that the SDR, spatial drawing right, is neither a currency nor a claim on the IMF. Rather, SDR can be exchanged for other currencies. It is one of the five currencies that I have mentioned already, shown in the PPT. And SDR can be exchanged for those currencies. So that was it, my presentation. This is my first video on video, so I think I have made some mistakes and I'm also kind of nervous, but again, I hope this video will help provide some information to people.